Let me paint you a scenario. You wake up on a normal weekday morning, nothing special. You grab your phone, open your banking app, and check your balance like you always do. Maybe you're waiting for a paycheck to clear. Maybe you're about to pay rent. Maybe you're about to move some money into investments because the market dipped yesterday. So you open the app and it's loading. Still loading. You refresh it. Still loading. Then finally, a message appears. Transfers are temporarily unavailable. Okay, annoying, but not a big deal, right? You close the app, reopen it, same message. Then you check Twitter, and suddenly people are posting videos of ATMs not dispensing cash. Your group chat starts blowing up. Someone says their wire transfer didn't go through. Someone else says their branch is closed due to technical issues. And for the first time in your life, the number sitting in your bank account suddenly feels theoretical. Now look, before we go any further, I want to see something really important. This video is not about fear. It's about understanding how the financial system actually works. Because here's the thing. Most people assume that because they can move money instantly today, the system behind it must be simple. But the truth is the opposite. Modern banking is one of the most complex systems humans have ever built. And when systems become extremely complex, governments start building emergency brakes. So the real question is this: is the US government preparing for a banking freeze? My name is Smith, and I spend way too much time thinking about how the financial system actually works. If you're someone who's trying to build financial security but constantly feels like the rules of money keep changing on you, hit subscribe and give this video a thumbs up. Because today we're going to talk about something that sounds dramatic on the surface, but once you understand the mechanics, it becomes a lot less mysterious. Here's the thing. Most people think their money is sitting safely in a vault somewhere. You deposit $5,000, the bank stores $5,000. And when you withdraw $500, they hand you $500 of your own money. Simple. Except that's not actually how modern banking works. When you deposit money into a bank, the bank doesn't just store it. They lend most of it out. Your $5,000 deposit might become someone else's car loan, or someone's mortgage, or a business line of credit. This system is called fractional reserve banking, and it's the entire reason economies grow, because the same dollar can be used multiple times inside the system. But here's what most people don't realize. This system works perfectly as long as people trust it. The moment that trust disappears, things get weird. Very weird. Imagine a stadium with 70,000 people. There are plenty of exits, everyone can leave safely, but if someone yells fire and everyone rushes the exits at the same time, the exits suddenly become the problem. Banks work exactly the same way, because if everyone tries to withdraw their money at once, the bank simply doesn't have it all available. Now you might be thinking, wait a minute, are you saying banks don't actually have our money? They have some of it, but not all of it at the same time, and that's by design. Now look, this is where history becomes really important, because banking panics are not new. In fact, they used to happen constantly. During the Great Depression in 1933, thousands of banks across the United States collapsed. People lined up around city blocks trying to withdraw their savings. The panic spread faster than the banks could handle. So what did the government do? They did something that sounds crazy today. They shut the banks down. President Franklin D. Roosevelt declared what was called a national bank holiday. For several days, banks simply didn't open. No withdrawals, no deposits, no transfers. Everything paused. Now you might be thinking, that sounds terrifying. But here's the interesting part. When banks reopened, the panic actually slowed down because the government had time to inspect banks, stabilize the system, and restore confidence. In other words, the pause helped stop the stampede. Now fast forward to today. The financial system is infinitely larger. We're not dealing with paper ledgers and local banks anymore. We're dealing with a digital network moving trillions of dollars every single day. According to the Federal Reserve, the FedWire payment system processes more than $7 trillion in transfers per day. $7 trillion per day. That's more than the entire GDP of many countries moving through financial pipes every 24 hours. And here's what most people don't realize. When that much money is moving that quickly, the biggest risk isn't slow panic, it's fast panic. In the past, bank runs happened physically. People had to drive to a branch, stand in line, fill out paperwork. Today, you can move $50,000 from your phone while sitting on the couch. And millions of people can do that at the exact same moment. Now, this is where it gets interesting. In March of 2023, when Silicon Valley Bank collapsed, depositors tried to withdraw $42 billion in a single day. $42 billion. Gone in hours. And regulators realized something important. The speed of financial panic has changed. Technology didn't just make banking faster, it made fear faster. Now you might be thinking, okay, but what does that have to do with a banking freeze? Good question, because here's the thing. When regulators look at risks in the financial system, they don't just ask, what if a bank fails? They ask, what if panic spreads faster than the system can process it? Because modern banking infrastructure has limits. Payment networks, clearing systems, settlement systems, all of them rely on a complex chain of digital plumbing. And if too much pressure hits those pipes at once, the system can temporarily jam. Think of it like a highway. If traffic increases slowly, everything flows. But if millions of cars try to enter the highway at the same time, you get gridlock. Banking works the same way, which is why regulators quietly design emergency tools. Now look, this doesn't mean the government is secretly planning to freeze everyone's money, but it does mean they're preparing for worst-case scenarios, because that's literally their job. After the 2008 financial crisis, regulators created new powers to stabilize failing financial institutions. They introduced stress tests, liquidity requirements, emergency lending facilities, and resolution mechanisms that allow regulators to step in when banks are collapsing. But here's the psychological twist most people miss. Financial crises are rarely caused by math. They're caused by emotion, fear, herd behavior, loss of trust. Because when people panic, they stop thinking rationally. They start thinking about survival. And when millions of people simultaneously decide they want their money right now, the system gets overwhelmed. Now you might be thinking, okay, Smith, but would the government really freeze the banking system? Here's the honest answer. They wouldn't call it a freeze. They would call it stabilization. Maybe certain transfers pause temporarily. Maybe withdrawal limits are imposed. Maybe certain institutions temporarily close. But the goal wouldn't be to trap your money. The goal would be to slow down panic. Just like stock market circuit breakers, when markets fall too quickly, trading stops temporarily. Why? Because panic selling can destroy markets. Slowing things down gives investors time to breathe. Banking systems follow the same logic. Now, let's talk about what this means for regular people, because this is where the conversation usually gets weird online. Some people jump straight into doomsday thinking. They start buying gold bars, hiding cash under mattresses, and predicting economic collapse. But that's not how smart financial planning works. Smart planning is boring. It's about resilience. Think about two people. Person A keeps $10,000 in one bank account. That's their entire emergency fund. Person B also has $10,000, but they split it. Maybe $6,000 in a checking account, $3,000 in a savings account at another bank, $1,000 in physical cash. Both people have the same net worth, but one person has more flexibility. If a payment system outage happens, they have options. If one bank experiences technical issues, they're not stuck. Because here's the thing most people don't realize. Financial stability isn't just about how much money you have. It's about how accessible it is. Liquidity equals flexibility, and flexibility equals security. This is why large investors hold massive cash reserves, not because they're afraid, because liquidity gives them control. During financial crises, the people with cash aren't panicking, they're buying opportunities. Now, zoom out for a second. The US financial system is still one of the strongest in the world. The dollar remains the dominant global reserve currency. US Treasury markets are the deepest and most liquid markets on Earth. So the idea that the entire system will suddenly collapse overnight is extremely unlikely. But temporary disruptions, those happen all the time. Payment outages, bank liquidity issues, market circuit breakers. Complex systems occasionally hiccup, and responsible governments plan for that. Because here's the mindset shift I want you to walk away with. Financial security isn't about predicting disasters. It's about preparing for uncertainty. You don't build an emergency fund because you know exactly when something bad will happen. You build it because you know something eventually will. The same logic applies to the financial system itself. Governments prepare emergency tools not because they expect chaos tomorrow, but because complex systems occasionally break, and the people who navigate those moments best are the ones who built flexibility into their financial lives. So, no, the US government is not secretly planning to lock everyone out of their bank accounts. But yes, they are constantly preparing for financial emergencies, because that's what responsible system management looks like. The key takeaway here isn't fear, it's awareness. Understand how the system works, build buffers, diversify where you keep your money, and focus less on predicting crises and more on making sure your life keeps working even if the system hiccups. Because in the long run, the people who win financially aren't the ones who panic first. They're the ones who planned ahead.